If you earn over £100,000, you could be paying an effective 60% tax rate without even realising it. It's a stealth tax, not writ large in HMRC's tax table, but triggered by the quiet withdrawal of your personal allowance. In this video, we'll explain how this hidden rate works, how to find out if you may be impacted, and most importantly, what you can do to avoid it, changing a 60% tax rate into 60% tax relief.
Most people are familiar with the official income tax bands in England, Wales and Northern Ireland: 0%, 20%, 40% and 45%. However, there is a quirk in the system that creates an effective 60% tax band for certain earners. To understand how this effective tax rate works, we first need to look at the basics of how income tax works. It all starts with your personal allowance. But first, if you have the benefit of working with Astute and this video raises any questions, then please don't hesitate to get in touch with your Astute financial planner. If you're new to Astute and would like to get in touch, we've created a link that sits below this YouTube video that will guide you to the right place.
Everyone starts off with a standard personal allowance. This is an amount each year that you do not have to pay income tax on. In the tax year 25-26, it's £12,570. In fact, it's been at this level since April 2021. To illustrate the personal allowance, let's imagine your income as cash being stacked onto a set of shelves. The bottom shelf can fit £12,570, which is your personal allowance and is therefore tax-free. Once you've filled that shelf, you must move on to the second shelf. This shelf holds £37,700 and is taxed at 20%. If you fill both shelves, this means that you earn at least £50,270. Above that, you have a higher rate shelf taxed at 40%. Here you can stack the next £74,870 of earned income, which will be taxed at 40%, taking your total income to £125,140. If you earn more than this, then you have an additional top shelf, a huge shelf that spans towards infinity, where you can stack the rest of your income and pay 45% income tax.
Now let's add in that quirk. Once your income exceeds £100,000, your personal allowance starts to disappear. It is eroded at a rate of £1 for every £2 over £100,000. This means that once you earn £125,140, you've completely lost your personal allowance. This means that the money on the bottom shelf has been displaced and is taxed as if it was never tax-free to begin with. You pay 40% on the £25,140 above the £100,000, which is £10,056, plus 40% on the personal allowance that you've lost, which is an additional £5,028 in tax. This totals £15,084 in tax on £25,140 of additional income, which is an effective rate of 60%. You can see the impact here in this table produced by the Institute for Fiscal Studies: a marginal rate of 0%, then 20%, then 40%, jumping temporarily to 60% before stepping down to 45%.
For those who have young children, there is a further sting in the tail. In England, the government offers free childcare benefits for children between 9 months and 4 years old. The government also offer tax-free childcare, providing you with up to £2,000 a year or £4,000 a year if your child is disabled. However, if you have adjusted net income over £100,000, you will not be eligible for most of the above. This isn't tapered either, so a £2 pay rise from £99,999 to £100,001 would see you going from being eligible for 30 hours free childcare for a 1-year-old plus tax-free childcare to not eligible at all, effectively acting as a cliff edge. It's worth noting that 3 hours for 3 to 4-year-olds is the benefit that remains despite your level of income. These benefits differ in other areas of the UK.
If you're thinking about whether this will impact you, consider your level of adjusted net income carefully. Start by adding up your salary, any bonuses, taxable pension income, rental profit after allowances, and savings interest. Now remove your gross pension contributions and donations to charity. If this totals over £100,000, then you could be subject to this effective rate.
If you don't earn over £100,000 now, but you're close, then this could pose a problem in the near future. We mentioned earlier that the personal allowance has been frozen since 2021. This achieves what is known as a stealth tax. As the years pass, average wages increase to ensure that we, employees and consumers, can afford the same lifestyle year on year as prices increase. However, whilst our income will increase, the personal allowance will not, which means that as a society, we will pay more income tax.
So what can you do? One effective strategy is to contribute to your pension. If you contribute into your pension, you can bring down your taxable level of income. Let's use an example here. If your salary was £125,000, we've established you will pay income tax on the 25 of £15,000. Instead, if you invest £25,000 into your pension due to the tax relief and re-establishing your personal allowance, you would save tax of £15,000.
You may have heard of salary sacrifice, utilised when making pension payments. This allows you to make payments into your pension before your gross income is declared. Many employers offer other perks to staff under salary sacrifice that may reduce your adjusted net income, for example, a car scheme or cycle to work scheme.
When you make gift aid donations, these bring down your taxable income. For some couples, it may be appropriate to assess how you receive your income collectively. If one of you earns over £100,000 and the other earns much less, is it possible to change working hours between you, or if you're drawing assets, draw them more evenly between you? Of course, this isn't possible for everyone, but it's certainly worth exploring for some.
The 60% tax trap is surprisingly common. Many people fall into it without realising, especially with rising salaries and frozen tax bans. If your adjusted net income is over or near £100,000, you could be losing thousands in unnecessary tax or missing out on valuable childcare benefits. The good news is that with the right planning, you may be able to reduce your tax bill and reclaim your personal allowance. A financial planner can help you to identify if your income is at risk, potentially regain your personal allowance, and reduce your tax burden in a way that aligns with your goals. As a reminder, if you have the benefit of working with Astute and this video raises any questions, then please don't hesitate to get in touch with your Astute financial planner. If you're new to Astute and would like to get in touch, then we've created a link that sits below this YouTube video that will guide you to the right place. See you next time.